Hello guys, it's me Emma, and welcome to my channel Wealth Canopy. Have you ever wanted to learn how to make money, spend wise, or just want to get a grip of your money here in Canada? On this channel, I will show you everything about Canadian tax, saving, loans, investing, and money tips all in one that is very easy to understand. Let's get started. What is a home equity line of credit? A HELOC is a revolving line of credit that allows homeowners to borrow money against the equity they have built in their home. It can be used for renovations, repairs, debt consolidation, investments, or other financial goals. A HELOC works similarly to a credit card. You can borrow, repay, and borrow again within your limit, but it is secured by your property. Understanding how a HELOC works, including how your home equity is calculated, how interest is charged, and what lenders look for, can help you decide. What is home equity? Home equity is the portion of your property that you truly own. It's the difference between market value and outstanding loans. For example, if your home is worth $400,000 and you owe $150,000 on your mortgage, your available home equity is $250,000. In Canada, most lenders allow total borrowing, your mortgage plus HELOC, of up to 80% of your home's value. If your home is worth $400,000, you could qualify for a HELOC of up to $170,000 after subtracting your remaining mortgage. When you access funds, you only pay interest on the amount you borrow. HELOC rates are usually variable and tied to the prime rate. You can draw whenever you need, repay, and borrow again, giving you continuous access to credit without reapplying. If you're deciding if a HELOC is right for you, here are some advantages and disadvantages of using a HELOC. Advantages include accessing cash at a low price. Interest rates are often lower than for other types of loans. You also get flexible access to cash. Unlike a fixed mortgage, you can use your line of credit whenever you want up to your limit. Most importantly, you stay in your home and keep your equity in an asset that can increase in value over time. For disadvantages, you need to qualify. Lenders require sufficient income, meaning retirees might struggle even with high equity. It requires monthly interest-only payments. To pay down the balance, you must also make principal payments. There are penalties for missing payments, including having your loan called. Always stay in touch with your lender if you have difficulties. Don't forget additional fees. You may be required to pay appraisal, application, and legal fees during the setup process. Finally, there's the potential for interest rate increases. Since it's variable, your interest goes up if the prime rate increases. If you want to see more videos like this, do not forget to subscribe my channel to stay tuned and hit the bell icon for notifications.